Today is going to be more technical. We are heading into day 5, Japanese candlesticks. Today you will be learning the language of the foreign exchange market. Now in today's module, it will be a 4-topic module starting off with Introduction to Japanese Candlesticks, followed by Single Candlestick Formations, Dual Candlestick Formations, and finishing off with Triple Candlestick Formations. Now as always, before we go into today's module, I just want to review very briefly what we learned in day 4. So you learned the main differences between a scalper, day trader, swing trader, and position trader, as well as the 3 types of analysis, which are technical, fundamental, and sentiment. At Six Figure Capital, our strategy is primarily technical based. So we are swing traders with a technical strategy. You also learned that journaling is a crucial part of trading that is often overlooked, and it will provide the best teaching experience available, which is your own mistakes. So let's head into today's module. Our first topic is Introduction to Japanese Candlesticks. Now, for anybody that's new to trading or investing, this topic will be completely new to you, and if you have previous experience, you'll know exactly what Japanese candlesticks are. So Japanese candlesticks originally were created by the Japanese to trade rice contracts back in the 1600s. Steve Neeson, who is known as the father of Japanese candlesticks, he brought them into the 21st century and he made them what they are today. Candlesticks are simply a visual representation of price. So when the exchange rate moves on your trading charts, they are represented in many different forms, but the form that we use is Japanese candlesticks. To me, they are simply the language of price. So here is a very basic example of what Japanese candlesticks look like. So when you hit the trading charts tomorrow in day 6, we will be going through, of course, the trading charts together. This is exactly what Japanese candlesticks will look like on a trading chart. So Japanese candlesticks, they are also referred to as candles or candlesticks. So you'll hear me saying candlesticks or candles. This simply just means Japanese candlesticks. They can be used in all markets. When I say all markets, this can be stocks, commodities, cryptocurrencies. So as I mentioned in day 1, our strategy can be applied to any financial market. And this is just simply a piece of the puzzle. So Japanese candlesticks, they can be used when you trade stocks, commodities, cryptocurrencies, and they can be used to analyze price. They can also be used on all time frames. So no matter if you're a scalper, a day trader, a swing trader, or position trader, you can use Japanese candlesticks for analyzing price. So candlesticks not only help you to understand what price is doing currently in the present, but can provide early indications of where price is heading. So you can predict price movements ahead of time. So you can predict price hitting a certain price level, whether it may be buying or selling, a week in advance or a month in advance. This is a key part of our strategy. So as I mentioned before, this is just one piece of the puzzle. Each candlestick represents 4 prices during a session. An open price, so of course, whether it may be buying or selling, it will open at a certain price. It will have a high price, so the highest point that candlestick reached within the session. A low point, so the lowest price that candlestick reached within the session, and of course a closing price. So let's say you're trading a 1-hour chart. Every single hour there will be one candlestick. And I will elaborate on this in tomorrow's module even further, but I'm just getting down the basics here. If you're trading a daily chart, for every single day, there will be one candlestick. So this records 24 hours of volume. And during this session, whether it may be a 1-hour time frame, a 4-hour time frame, or a daily time frame, you will have what is a open price, a close price, a low, and a high. Now, what we're going to do is we're going to break it all down with an example here. So here we have a bullish candlestick, and I primarily use blue for bullish candlesticks. This can be green, it can be black, it can be any color you want. We will touch on this in later modules, but for now, just understand that bullish candlesticks for me are buying volume. So of course, buying candlesticks. So this is a bullish candlestick, and you can see here that the base of the candlestick, we have what is called the body. And the black line that runs through the middle is what is known as the wick. Now, as mentioned previously, we have the open price. So when you have a bullish candlestick, the open price is always at the bottom and the closing price is at the top, because of course prices opened and price moved up, and of course when you're buying, price increases. So of course price closes at the top, and the low price represents how low price hit during that session. So let's say this was a 1 hour time frame, and this candlestick represented 1 hour of buying volume, or 1 hour of trading volume I should say. This represents the lowest price that it hit during the session, but of course buyers regained control and pushed price back up. Of course we have the highest point, so the high of the candlestick. This represented how high price hit during the session, but of course sellers regained control, pushed price back down, and then that's where you find the closing price to finish off the candlestick. Now here we have a bearish candlestick, just the exact same as before but flipped. We have of course a different color, and the open and close as it is now at different ends of the candlestick. So you can see for red, I use this for bearish, for selling candlesticks, for selling volume. Again, this is the body of the candlestick, the wick of the candlestick. The open price this time starts at the top, because of course when you're selling, when you've got a bearish candlestick, price decreases. So you're looking for price to drop. So when you've got a bearish candlestick, price is decreasing. And if you don't know already, bullish simply means buying, bearish simply means selling. And of course at the bottom here we have the closing price. So since price opened, price dropped, and we have the closing price at the bottom, which means it is a bearish candlestick. This is selling volume. And again, we have the lowest price that price hit during the session and the highest price. Now what we're going to do is we're going to move on to our second topic, which is single candlestick formations. So these are formations that you will see every single day in any market on any time frame. So the main type of candlesticks are bullish and bearish, as I've mentioned previously. And of course I'd like to make sure you get down the basics. Of course, lay a solid foundation before you go ahead with the more technical aspects of trading. So bullish simply means price is going up, increasing or buying, and bearish simply means going down and price is declining or selling. So let's go over the main examples of bullish and bearish candlesticks. What we have here is what's known as a bullish Marubozu. So you don't need to concern yourself with the names at the moment, but of course it's good to put them out there, so eventually you guys will remember these candlesticks by their names. But for now, just remember the shape of the candlestick and what it looks like and what it represents. So again, when it's a bullish candlestick, you have the open price at the bottom and the closing price at the top. You can notice here that there are no wicks with this candlestick, and this candlestick, the word Marubozu, stands for bald head in Japanese. So it simply means there are no wicks. There's no high price, there's no low price, there's no wicks in there whatsoever. We've got the open and the close. Its name reflects the formation's appearance, as it has no wicks, as I've just mentioned. And this is seen in an aggressive move when buyers are completely in control. So we didn't have a low price, so as soon as price opened at the bottom there, price went straight up. There wasn't a low in this candlestick, meaning sellers didn't push price below the open price. It just opened and price increased straight from the open price and closed at the top. The candlestick formations that follow this are crucial and can provide early signs of future price direction. So this, again, one piece of the puzzle, but it's a very good candlestick to use in your analysis. And this type of candlestick is typically seen after a reversal. So after you've confirmed a reversal, this will confirm a very bullish or bearish move in a certain direction. So for this candlestick, it's a simply bullish candlestick. So this will be followed by a bullish reversal. Here we have a bullish long day. Now this time it's similar to the Marubozu. It has the open price at the bottom and the closing price at the top, but this time it has a low and a high. So of course sellers were active in this price session. You can see that price was pushed lower. We've created a low price, and of course sellers decreased the price when it hit the high, making the closing price slightly lower. So it's an easy candlestick to remember, as it also reflects its name. A long day represents a long price movement from the opening price to the closing price. This formation will appear in a variety of market situations, and typically it will appear at the beginning or end of a trend. similar to the Marubozu. The Marubozu, I would say, appears in all market situations, and this will make perfect sense once you get towards the end of the 14-day course, once we learn the bulk of our technical based strategy. But the long day typically appears at the beginning or end of a trend. Now, this candlestick is a reversal based candlestick. One of my favorite is the bullish hammer. Now remember, all these candlesticks are bullish, they're all buying candlesticks. So again, we have the open price and the close price, which are relatively the same in this situation. They're quite close. And we have the low price, which is, again, it looks like a hammer. So a bullish reversal formation that occurs during a downtrend. So this candlestick, the hammer candle, will appear at the bottom of a downtrend. And the reason it's called the hammer candle is because it's hammering out the bottom. And it literally looks like a hammer. It's the easiest candlestick to remember. So as I've just said, it's indicating the market is attempting to determine a bottom. So the market is trying to bottom out. And when it happens, this is signaling a reversal. So the long wick indicates sellers pushed price lower, but the buyers were able to overcome the selling pressure. So basically, the buyers overcame the selling pressure and they regained control. Of course, the price opened very high and it just dropped. And that's what created our low price way down the bottom there. And that's what gives it this very distinct appearance of the hammer candle. But buyers regained control and they managed to push price back up above the open price, and it closed as a bullish hammer candle. So again, the candlesticks that follow this formation are paramount. This is what's typically seen in a reversal situation. This is a key candlestick, especially once you learn the rest of our technical based strategy towards day 9, day 10. This candlestick is extremely important. So it's very good for indicating a reversal. Now, on the opposite end, it's pretty much the hammer candle, but flipped. It's called a bullish inverted hammer. Again, we have the open price at the bottom and the closed price above the open price. Now, this time, buyers were trying to push price higher, but the sellers managed to regain control, but buyers managed to keep the closed price above the open price. Therefore, it closed as a bullish candlestick. So it has a similar meaning to the hammer candlestick, also a bullish reversal candlestick. So when you see these type of candles, they indicate a reversal. And that's the key word there, indicate. It doesn't mean a reversal is going to happen, but we can use this, of course, in alignment with other analysis to help us predict extremely profitable trading situations. This typically occurs when price has been declining. So you will see this again at the bottom of a downtrend, or you may see this after a pullback. It shows an attempt of buyers trying to push price higher, but sellers pushing price back down, resulting in a lower close. So as I mentioned, price opened at the bottom. Buyers instantly pushed price up to the top, creating a higher price, but sellers, of course, managed to regain somewhat most control, but they didn't manage to create a bearish candlestick, and the close price was slightly above the open. Now, when it comes to hammer candles and inverted hammers, I would say the wick, you want it to be 3 times the size of the body. So we can see we've got a really small body at the bottom there. You want the wick, so that big long wick, you want that to be 3 times the size of the body. Now heading on to our bearish candlesticks, so we had our 4 main types of bullish candlesticks. We've got 4 main types of bearish ones I would focus on. So here we have the bearish Marubozu. Again, we have the open price at the top here, as mentioned in our bearish candlestick tutorial at the start in our first topic. And the closing price is always below the open price in a selling candlestick, so in a bearish candlestick. The exact same as before, but this time it is a bearish formation. So when you're looking at the bullish Marubozu, of course, the open price is at the bottom, the closing price is at the top. This time, the open price is at the top and the closing price is at the bottom. So this single candlestick should have a long body with no wicks, as mentioned before. And this is seen in an aggressive move when sellers are completely in control. So you may see this when we have got a bearish reversal. So price has been uptrending for a long time. Price has been increasing for a long time. And eventually, we will see a reversal followed by something like a Marubozu in the opposite direction. So it's an extremely aggressive move where sellers are completely 100% in control. The candlestick formations that follow this, again, are crucial and can provide early signs of future price direction. Sometimes you may have this where it's in the same direction as the trend, and this is the last candlestick you will see in the trend, and the candlesticks that follow this are a key indication because this could signal that price is exhausted and maybe the sellers are completely out after this candlestick closes. Well, of course, if it's in a bearish situation, you'd be looking for this in a downtrend. So if it was a bearish Marubozu, you would be looking for a bearish Marubozu in the direction of a downtrend, and at the bottom of the trend, it would signal that sellers are exhausted. Of course, only if it was followed by certain other candlestick formations. So in the uptrend comparison, that would be a bullish Marubozu. So you could have an uptrend, price has been increasing for a long time, and the last candlestick was a bullish Marubozu. The candlesticks that follow that, it could be a reversal candlestick or indecision candlestick, which we will mention in today's module. This would indicate that buyers are exhausted, or on the flip side, sellers are exhausted. And we will go into this in further modules, but we just simply want to introduce the formations today, and we will further utilize these in later education. So here we have the bearish long day. Again, pretty much the exact same as before with the bullish long day. The only difference is you have the open price at the top and the closing price at the bottom. Now this one has a low and a high price, an easy candlestick to remember as it also reflects its name. As I've mentioned before, it represents a long price movement from opening price to closing price. This formation will appear in a variety of situations, and this one in particular will appear at the beginning or end of a trend. So after a reversal has took place, you will see this at the beginning of a trend, or as I mentioned with the Marubozu, this might be the last candlestick in a trend, in a downtrend for a bearish candlestick, and it will be followed by a reversal and price will start trading in the opposite direction. So this is a good candlestick to look out for. Now here we have the bearish hanging man. Now this looks like the hammer candlestick, except we have the open price at the top and the closing price at the bottom. Now you can see that, of course, price dropped and we created a low price. This is the exact same appearance as the hammer candle as mentioned, and it serves a totally different purpose. This time it indicates a bearish reversal, meaning sellers are beginning to outnumber buyers. So you can see once price opened at the top, sellers pushed price all the way down to the low, which would have created a Marubozu looking candle, but buyers managed to regain control during the price session and push price back up to where it closed. So again, in this situation, you want the wick of the candle to be 3 times the size of the body. So you can see here it's definitely 3 times. You could even say it's 4 or 5 times the length of the body in this situation. And you will typically see this formation at the end of an uptrend at a key resistance level in the market. And don't worry, this will make perfect sense once you get onto modules day 7 or day 8. Now here we have a bearish shooting star. So this looks like the inverted hammer candle, sorry. You have an open price at the top, a closing price at the bottom. Now this time, you will typically find this candlestick at the top of an uptrend. So this could be followed by, you could have a long day followed by a shooting star candle, which indicates a reversal and price will start trading in the opposite direction. So price in this situation, it has the open price. Price is pushed up by buyers, indicating that this uptrend is going to continue, creating the high price. But during that price session, sellers managed to regain control and push the price back below the open price to create the close at the bottom here. So the shooting star candle looks identical to the inverted hammer candlestick. This shows that price opened low and rallied after buyers flooded the market. So buyers are flooding in, which creates the high price, and then sellers managed to regain control and push price back below the open to create a bearish candlestick. So again, this formation is seen at the end of an uptrend, indicating a reversal. Like all reversal candlesticks, the formations that follow are crucial. So these are good candlesticks to note. They will They are extremely important when you align them with other technical working tools. So you will learn this throughout the 14-day course. But using them solely, I wouldn't say they're highly effective. So you need to use them in relation to other technical working tools. So they simply provide an indication. So neutral candlesticks are our next topic within the single candlestick formation. So as I mentioned, you have either bullish or bearish candlesticks, but you actually have a third type, which are neutral candlesticks. So neutral meaning indecisive. These candlesticks appear frequently in key areas of the market where buyers and sellers struggle to gain control, resulting in a draw. The color of these candlesticks are not important, only the formation. So let's go over the main types. Before we do this, I'm just going to take a quick break. This is an extremely long module, and then we'll jump back on to finish off the rest of day 5. All right, we're back. Let's continue with day 5. We're going to head into our neutral candlesticks, and the first example is a spinning top. So as you can see, it has a low and a high price like our previous candlesticks, but in this situation, the body is black. And the reason it's black is because it doesn't matter if it's a bullish or bearish candlestick. So this can be blue or red, depending on the color of your candlesticks. This is completely irrelevant. And this candlestick forms when there is indecision between buyers and sellers. So I typically refer to these candlesticks as neutral candlesticks, of course, stalling candlesticks or indecision candlesticks, or maybe there's indecisive price action. That's typically what you would hear me saying. So this suggests a possible change in trend. So you will find this formation after an extended uptrend or downtrend. It can be found anywhere in the market, but in relevance to our strategy, which you will learn throughout the 14-day course, you will find this at the end of an uptrend or downtrend, and this indicates a reversal may take place. These candlesticks, can provide excellent exit or entry points in certain trading situations. So again, they are relevant to our strategy, and they are extremely useful when trading a pattern-based strategy. Now, our next neutral candlestick is a long-legged doji. Now, it's the same as before. We have the low and the high price, but the body is significantly smaller. The open and close price is almost exactly the same. So as I've mentioned, the opening and closing prices are almost equal in this formation, and the long-legged doji also shows indecision between buyers and sellers. If this formation occurs after an extended uptrend or downtrend, this also indicates a reversal may take place. So it's extremely important to keep an eye on these candlesticks once you learn the rest of your technical based strategy. As always, pay close attention to the candlesticks that follow this formation. So again, this is just one piece of the puzzle. You want to analyze not only the candlesticks that happened prior to this formation, but the ones that happened after. So you can correctly analyze where price is going in the future. Our next candlestick is a gravestone doji. So again, we have a high price but not a low price in this situation. A gravestone doji is similar in appearance to a shooting star or inverted hammer. The only difference is the body is minuscule. So there is generally no lower wick. So we have a higher wick, a high price, but there's no low, and the open and close prices are almost equal. The long upper wick suggests that the buying pressure within the period was countered by sellers. So this may be a 1 hour period, a daily period, it could be a weekly trading period. Within that period, it suggests that the buying pressure was completely overwhelmed by sellers, but buyers managed to regain control at the bottom, but there was a slight amount of indecision in the market. And finally, our last neutral candlestick, which is a dragonfly doji, we have a low price. And this one is similar in appearance to a hammer or hanging man candle. There is generally no upper wick in this situation, and the open and close prices are almost equal. So you can see a pattern here between all these neutral candlesticks across these doji candlesticks. The open and close price is pretty much the exact same. They're minuscule. The bodies are almost non-existent. The long lower wick, suggests that the selling pressure within the period was countered by buyers. So this could be a 1 hour period or even a 4 hour period. Now on to our third topic for today, which is dual candlestick formations. Here we have a bullish engulfing pattern. Now this pattern in particular starts off with a bearish candlestick, and it's typically found at the bottom of an extended downtrend. So of course we have a small bearish candlestick with the open price at the top and the closing price at the bottom, followed by a bullish candlestick. Now you can see here, once price closes with the bearish candlestick, the next candlestick, when it opens in alignment with the closing price. So you can see, if you look at the closing price on the bearish candlestick, the open price for the bullish candlestick, the blue candlestick, is at the same level as the closing price. And this is what happens in the market. Whenever a candlestick closes, the next candlestick opens at the same level, and then of course buyers and sellers dictate the next movement, the next exchange rate. So price is opened at the bottom here and it's closed at the top, and this candlestick would be a bullish engulfing. So you're really looking, a bullish Manabozu, sorry. So you're really looking for a bullish Manabozu or a long day candle for the second candlestick in this formation. So the bullish engulfing formation signals a strong change in trading sentiment. It is seen when a bearish candlestick is immediately followed by a larger bullish candlestick. And the bullish candlestick engulfs the smaller bearish candlestick, as you can see. So the bullish candlestick is typically 3 times the size of the smaller candlestick. And the market has to be in a clearly identifiable downtrend for it to be valid. So as I said, you're looking for this formation at the bottom of an extended downtrend. Now we have the bullish tweezer bottom. Again, this is found at the bottom of a downtrend, so the bottom of the market. It is, of course, it includes a bearish candlestick and a bullish candlestick. So we have the open price at the top with the closing price at the bottom for the bearish candlestick. And then again, price opens at the bottom for the bullish candlestick and closes at the top. So this candlestick, it's in the name. It looks like a pair of tweezers. So we've got tweezer bottom. This formation typically occurs following an extended downtrend, and these stalling candlesticks indicate a market reversal may occur. So as I mentioned before, I typically refer to reversal candlesticks as stalling candlesticks, and decisive candlesticks, neutral candlesticks, if it's a doji. So stalling is a word I use quite a lot. The first candlestick is bearish, followed by a bullish candlestick. And just to note, the wicks should be of equal length. So you can see here the low price, which I have not mentioned. Of course, you guys know what the high and the low is by now, so I'm not going to keep dragging it out too much. But the low price for this candlestick should be of equal length for both candlesticks. Now, as I mentioned previously, the market is never perfect, so they will be slightly different, but you're really aiming for an equal length for the low prices. Now on to our bearish dual candlestick formations. We have a bearish engulfing setup here. First of all, you have a bullish candlestick followed by a bearish Manabozu or a bearish long day. Of course, price opens, it then closes above, creating a small bullish candlestick, followed by a bearish candlestick where price opens at the top and completely overwhelms buyers and price closes at the bottom. So the bearish engulfing formation signals a strong change in sentiment. So this is typically found at the top of an uptrend, so at the end of an extended uptrend, and this is why it signals a strong change in sentiment, because buyers have been in control for a long time. We're trading in an uptrend, and this is typically found at the top of the market, signaling that the buyers are out and the sellers are in. It is seen when a bullish candlestick is immediately followed by a larger bearish candlestick. So you can see we've got a small bullish candlestick followed by a much larger bearish candlestick. Now, the bearish candlestick totally engulfs the bullish candlestick. So again, it's typically 3 times the size of the blue candlestick. So the red candlestick, the bearish candlestick, is typically 3 times the size. And the market has to be in a clearly identifiable uptrend for it to be valid. So again, this typically forms at the top of an uptrend. Now on to our final formation for the dual candlesticks. This is a bearish tweezer top. So we had a tweezer bottom, now we've got a tweezer top. So this is typically found at the top of an uptrend. Again, we have a bullish candlestick followed by a bearish candlestick, and this formation typically occurs following an extended uptrend. And these stalling candlesticks indicate a market reversal may occur. So these are key formations to pay attention to when you're trading. The first candlestick is bullish, followed by a bearish candlestick, and the wick should be equal length. So as mentioned before, to simplify this, the candlesticks should have similar highs and lows. So in this situation, the highs should be of similar price, or similar length. And with the tweezer bottom, the lows should be of similar length or price. Now on to our final topic for today, which is triple candlestick formations. Here we have a bullish morning star. Now, for these to be valid, you of course need three specific candlesticks. We have a bearish candlestick followed by an indecision candlestick such as a spinning top or doji. The color of this candlestick, if it's bullish or bearish, it is irrelevant. And the third candlestick in this formation is bullish. The morning star is found at the end of a downtrend, indicating a reversal. Now the first candle is bearish, the second can be either bullish or bearish, indicating indecision in the market, and the third candlestick is bullish. Now this needs to close beyond the midway point of the first candlestick. So as you can see here, I've put a line across where the blue candlestick is. When we have the third candlestick forming, it needs to close above the halfway point of the bearish candle, the first candle in this setup, for it to be a valid morning star. Now our second triple candlestick formation for the bullish patterns, which is a three white soldier. So in this formation, there are no indecision candlesticks, no bearish candlesticks, just simply three bullish candlesticks, one after another. Now this formation occurs after an extended downtrend, signaling a reversal has occurred. The first candlestick is typically small in appearance, so you can see here it's a very small candlestick to start off this move. The second candlestick must be bigger than the previous candlestick's body, so you can see the second candlestick is almost twice the size of the first. So the body of the second candlestick is almost twice the size. The third candlestick should be equal or greater size than the second, so we can see it's almost twice the size. So you can see as the candlesticks progress, they get bigger in size. So this is typically found after a hammer candle or a doji, for instance, a neutral candlestick or an indecision candlestick, which indicates a reversal. And then this is the candlesticks now changing the direction of the trend. So we were in a downtrend, a hammer candle or an indecision candle formed at the bottom of the market, and then this is where the three white soldiers appear, changing the direction of the trend. Now onto our bearish setups, we have a evening star here. Again, we've got three candlesticks in this formation. We have got one bullish, an indecisive candlestick, and one bearish. This formation, of course, it consists of three specific candlesticks. So you're really looking for a Marubozu followed by a stalling candlestick such as a spinning top and then a long day. The evening star is found at the end of an uptrend, indicating a reversal. So if you imagine you've got an extended uptrend, price has been increasing for a while, you will have a Marubozu, which is the last candlestick of the uptrend, a very extended aggressive move, followed by an indecisive candlestick such as a spinning top or a doji, and then you've got the sellers who are now in control, and that's where the third candlestick forms. So again, the first candlestick is bullish, the second can be either bullish or bearish, indicating indecision in the market, and the third is bearish, and again it needs to close beyond the midway point of the first candlestick. So you can see here I've got a line going across. You can see that's roughly the midway point of the bullish candlestick on the left. You want the red candlestick, the bearish candlestick, to close at least halfway. So again, you can see they're pretty much equal length. If not, the red candlestick is almost bigger if you include the wicks here. So you want it to be at least half the length for it to be a valid evening star. Now onto our final setup, which is the three black crows, similar to the three white soldiers. Again, in this situation, there are no bullish candlesticks or indecision candlesticks, neutral candlesticks. It is just simply bearish candlesticks, and three of them. So this formation occurs after an extended uptrend, signaling a reversal has occurred. The first candlestick is typically small in appearance, and again, the second must be bigger than the previous candlestick. So again, we can see that the second candlestick in this formation is almost double the size of the first. The third candlestick needs to be of similar equal size or greater in size than the second. So we can see here it's almost twice the size of the second candlestick. And this is, again, it forms at after a reversal has taken place. So let's say price had been increasing for a long time. We seen something like a shooting star, which is a reversal candlestick, followed by a doji, or it could be a spinning top, a neutral candlestick, and then this is where you would see the three black crows, which of course now the downtrend is in full swing and the reversal has taken place. So what I have done to simplify all of this education, I have included an ebook for you guys, a PDF called The Language of Price, and it is a simple handbook on Japanese candlesticks. It's for you guys to use whilst you're trading. So the download link is below today's video. The Language of Price, it is a PDF. It's an ebook that you guys can use, so you can print this off if you want. You can keep it open on your laptop or computer whilst you're trading, and it has every single Japanese candlestick we have mentioned in today's module. Now on to rookie mistake number 5. So of course we've had 4 so far, and these are what not to do in your trading career. So these are real trading mistakes that have cost me a lot of time and a lot of money. You guys get the gist by now. And today's rookie mistake is ignoring the translation. And this is a very simple topic here. Everything that happens in the financial markets, no matter if it's forex, stocks, commodities, cryptocurrencies, it really does not matter. It is displayed through price. And the way we analyze price is in the form of Japanese candlesticks. So it is beyond me why any trader would deviate from this very simple representation of price to use an indicator-based strategy. And we've all been there. I've been there. If you're new to trading, of course, you've not done this, so thankfully you'll learn from this mistake. But if you've had previous experience, you've more than likely done this in the past. You've used several indicators on a chart instead of analyzing the clearest form of what price is doing through analyzing Japanese candlesticks. So price is the most reliable indicator a trader could use. It's clear, it's not a lagging indicator, you're getting it live. Whereas if you're trading based on Bollinger Bands or MACD or RSI, they're all lagging indicators. So use this to your advantage. It is now your new language. So utilize your ebook. All the candlesticks we spoke about today are in there. So I just want to wrap it up for today. It's been a very long module. I hope you guys found a lot of useful information in today's module. You've now learned the basics of reading price action, and trust me, this will make perfect sense once we move on to day 6. And this is a basic understanding of reading financial charts. So again, tomorrow's module, we will be going into a very simple overview of how to use the trading platform where we do our analysis. And this will help you to better understand how price moves. Remember, a candlestick is either bullish, bearish, or neutral. And every candlestick can provide an indication. Remember, an indication, it isn't a sure thing. So of course you need to use a various amount of technical working tools to perform successful trading. You can't just use candlesticks and become a profitable trader. I mean, you could, but of course you want to use everything to your advantage to pick out the best possible opportunities the market has to offer. So it is only an indication of where price is going next. And again, you can use this to your advantage. But as I said at the start of this module, Japanese candlesticks for us is just one piece of the puzzle. So don't forget to print off your ebook and use this whilst you're trading. This will be extremely useful, trust me. No matter if you've had previous experience and you think you know these candlesticks, get them printed off and sit it on your trading desk. Now in tomorrow's module, which is day 6, Chart Your Way to Success, we will be covering Introduction to TradingView, followed by a hand-holding guide to financial charting and social networking. So a very exciting module. Again, if you guys have any questions whatsoever, email me at lewis@sixfigurecapital.com, and I'll see you on the next video.